Today we're going to be talking about the S&P 500 and the important role it plays in investing. Think about that. As we did before, we're going to be looking at finance.yahoo.com, or Yahoo Finance as it's called. And essentially what we're going to do is look, as we can see, it's the number one thing you see on this little, I don't know what they call this, hotbar, sidebar, ticker, but it's the number one thing that you see, and there's an important reason for that, because it probably is the number one important thing for basic investing, at least in the stock market. So let's go ahead and click it. So these are the S&P 500 futures. Because of the time of day, it's 3:48 in the morning, and so the stock market's not open. It opens at 6:30 Pacific time, 9:30 Eastern time in the United States. But the S&P 500 futures should bring us to the SPY. Is it SPY? Or this is just the S&P futures. But anyways, so let's look up SPY just for fun. So this is SPY. This is one of the original tracking funds, trust is what they call this, for the S&P 500. The S&P 500 has been around for 70-ish years, almost 70 years, I think the mid-50s, 1950s, of course. And the role it's taken on is basically as the sort of the starting point for investing in stocks. So what the S&P 500 is the top 500 companies in the United States. Essentially, they can have foreign interests by market cap. And now they take those 500 companies. Now, it's not always the top 500 companies. It's about the top 500 companies, because at the bottom, you have companies going in and out from market capitalization, but they don't rebalance that every day. I believe it's done maybe once a year, maybe a little more often than that. And also you have companies that are being purchased or go bankrupt or whatever, that are removed from the S&P 500. So, there may not be actually 500 companies in the S&P 500. But that being said, it's about 500 companies, and they represent a large portion of the United States stock market. And they are a pretty good representation. And this is where the importance of these companies comes, this composite comes in place, this index. The S&P 500 is basically used as a default for what we call beta, which is the market essentially. Beta risk is, we've talked about this in the past, but if you haven't been here for those conversations, the beta of the market is 1. And so if a company has a beta of, say, 1.1, then their market risk is 10%, basically 10% higher than the market. And this becomes an extremely important equation when evaluating individual stocks and the market as a whole, because you can, of course, add up all those evaluations to come up with the market and see if what's going on in the market makes sense. Now, think about these implications. One, the S&P 500 is, as an investment index, there's many ways you can invest in the S&P 500. SPY, which I brought up here, is one of the first ways you could do that. But you can go down here. You can see the expense ratio is 0.09%, which seems to be extremely low. But there are investment funds out there. I think Fidelity has one. It might be as low as 0.01%. So, depending on your needs, that was Vanguard, sorry. But there you go. The Vanguard is 0.003. And I think if we just write Fidelity 500, there it is, Fidelity 500 index. That is the expense ratio of, where is it? I'm going blind at the moment. I don't see the expense ratio. Oh, there it is, 0.01%. Now imagine that, 0.01. I don't know if you saw as I was going through quickly, but the beta for all these is 1, because they're all trying to match the market, which is essentially, by default, the S&P 500. Now, of course, is that really true? No, it's just a nice stand-in for what's out there. So because of that, because investing professionals are generally using the S&P 500, it becomes important just for that fact. So it is followed, as you could see, it was the number one thing that is up here, right? And that is the reason why, because this is what people are following for the broad U.S. market and how it is doing. So that's one thing. So another important thing about it is because of its broadness, it offers diversification. I mean, that's kind of the point of the whole market. When you have the whole market together, that's as basically as diversified as you're going to get, theoretically. I'm sure there's also theories out there that you can get more diversified, but essentially what we're talking about, beta of 1, we're talking about a well-diversified portfolio, and that's what the S&P 500 in general can offer. So when you invest in the S&P 500, you are getting a diversified portfolio right off the bat without doing any extra work. And as you can see, it's so competitive that Fidelity offers a 0.01% expense ratio. So that means that they charge you 0.01% on your money. Let's think about that. There was a time 1% was considered low. And then I remember like 0.97%, and they're down to 0.01%. If you got $100,000, what are we talking about there? If you had $100,000, you're talking about them charging you $10. Is that right? $10? They're charging you $10 a year off $100,000. That just seems crazy. Let's see, 100,000 times. If it was 1%, it would be 1,000. 0.1% would be 100, and yeah, $10 is what Fidelity is charging you to invest in their S&P 500 index. Now, I believe this is a mutual fund. It's not a ETF or even a trust like the SPY. And those are different things. And you would use the SPY essentially to invest in if you wanted the benefit of being able to take your money out or buy at any particular time. Now think about that. So we saw the expense ratio for SPY is 0.09%. So you're talking on $100,000. Now you're getting charged $90. So there's an $80 surcharge per $100,000 to be able to trade it at any time. So it might be worth it. I mean, if you're buying it, theoretically, no, it's not worth it. You should just get the one with the lowest expense ratio. But practically speaking, if you need to sell yours at a particular time, or if you think you have the ability to make up that difference, and we're not talking a lot of money, said $80. If you can make that up in the trading aspect of it, which is not necessarily easy, but that's what you're paying for. That's what you're getting for your $80. You're not getting nothing out of it. That's why everybody doesn't flood into Fidelity. And I mean, in my case, I do own some SPY. I don't own any Fidelity, and that's not because Fidelity is bad. If I was going to put more money into the S&P 500, I probably would invest in the Fidelity 500 index. But my issue is that I already own SPY, and I don't want to sell it to then buy Fidelity 500 index and save $80. The taxes, I have a substantial gain on these shares, so selling it would be, selling it to save $80. I probably do have at least $100,000 in the SPY. So if I sold it to save, $80, I would be paying a lot more than that in taxes. So there's another reason why you may not, why you may hold it. But I do like the idea of being able to sell it at any time of the day or buy it at any time of the day. I mean, that's another thing. So, there's been plenty of times where the stock market has dipped quite a bit during the day. And, you've had these essentially computer glitches, you would call them, where the stock market or something in particular drops. Well, you can't do that if you're buying a mutual fund, right? If you're buying an index mutual fund, you're only buying it at the end of day. So yes, you could go in and say, hey, give me $100,000 worth of FXAIX right now. But right now is not what it's trading at. Yes, theoretically, it's going to be the same price, at the end of the day as it is at this very moment. There's nothing distinguishing the end of the day to this moment. But if you believe that you have the ability to take advantage of a situation because of, let's say, a computer glitch, then of course, you're going to need an instrument like a SPY where you can buy it instantly. And SPY is not the only ETF out there, just the one where I'm mentioning right now. So I'm kind of gone far afield. But anyways, so, all of these different, you have mutual funds, you have ETFs, you have the trust, the SPY is a trust, that you can invest in the S&P 500. And, there are trillions of dollars invested in the S&P 500. So it's huge just by itself. Even if it wasn't the default beta, even if it wasn't the default market for equations, it would still be important just because of its size, the sheer amount invested in it. Now, of course, that's probably why there's so much invested in it, but, just as an aside. So let's take a quick look. We have this open here. You can see the beta here is 1%. Now, as this is just a turnover, whatever. But you can see here's the dividend return was $2.40. The yield was $1.45. It's 1.45%. So for every $100 they have of your money, or let's say every $100,000 that they have of your money, you would be getting back $1,450 in dividends. That's, as we always say, it's neither good nor bad. It's just part of the investment. That's the investment, the dividend yield. And, that's a substantial amount of money. If you have $100,000, of course, if you have $1 million now, you're talking $14,500 a year that you're getting just in dividends, not including the capital appreciation. So what's capital appreciation? Essentially, let's just go to 5 years. So the capital appreciation is, of course, unknown, but 5 years ago it was trading at 97. So, it's gone up to 168 as of today. So from 97 to 168. So if you want to do some rounding, you're talking about a 70% increase in the last 5 years. It's not a bad return. So, currently this is the funny thing, year to date, it's 26.29. Well, the year to date, we're on the 23rd day of January. So, okay, year to date, kind of a meaningless number. But we can look at a year ago today. A year ago today, it was at 141. So what was it and it was 164. So maybe that's not, that's probably not year to date. That looks like it's actually, there's no way that's year to date, right? We go from 164 to 168. So it's probably not. It's probably what they're looking at, 26%. Yeah, it looks like that's actually a year figure. It makes more sense as a year figure than as a year-to-date number. So interesting. Anyways, let's take a look here. Last capital gains 39. Now that's something you have to think about also when you own something like the S&P 500. Generally speaking, there are dividends. Even if they're rolled in, if you don't have it inside a retirement account, you're going to have to pay taxes on this money, whether you're using it or not. Depending on the situation, you might have to elect at least to reinvest the money. So there's some transaction costs along the way when you do these things. They're in something that's so heavily traded, probably very low, but still exist, and those eat into your returns. And they call this large blend because it is 500 large companies, and it is weighted by market capitalization. Now, what does that mean? What is weighted by market capitalization? That means the bigger you are as a company, if you're a part of the S&P 500, and we're talking about market capitalization. And market capitalization is just basically outstanding shares that can be traded times the price of the shares. That's market cap. And they look at each company, and the bigger you are, we'll take a look at the holdings here. The bigger you are, the greater percentage you will be of the index. So as you can see here, you've got Microsoft, Apple at 7%, a little over 7% each. Just think about that. That's 7% of this gigantic fund. So, you drop down pretty quick from your 7%. So now you're down to 3. Google is only 2%. Meta 1.89%. While Google has two different, has different classes, so that's probably why. But so 3.8 together combined. So yeah, I mean that's basically roughly half of what Microsoft and Amazon are trading at. But just think about that. These companies alone represent 31% of what we consider a good representation of the U.S. market. So what happens with these 31% is important. So what's also important is that because the S&P 500 is so ubiquitous, you are probably invested in it in one way or another. You may be invested in it in your 401k. It might be going under the name of FXAIX if your company uses Fidelity, or if it uses Vanguard, VOO, or some other mutual fund company. So they're out there. You might be invested in it. If you see something that says large, if you have a mutual fund in your 401k and it has an extremely low expense and it's a large company mutual fund, odds are it's a S&P 500 mutual fund. And if you read a little bit about it, you'll know that you'll see that that's what it is. I mean, that's how you get these low expenses. Now, in general, index funds are cheaper to run because it's all mathematical. All they're doing is trying to keep this balance based upon market cap. They'll buy a block of shares here, sell a block of shares there. They're just trying to keep it close. They don't have to be exact. You don't have to be exact to do this. They have plenty of shares held by, within their company. Within, Fidelity is a brokerage as well, so they can borrow and sell shares of their patrons. So there you go. That's kind of some of the very basic things when you're looking at the S&P 500. Now, why would we consider the S&P 500 as an investment initially? One, it's kind of a good starter investment, right? Because you are investing in something that is representing the entire United States, essentially, and it's diversified. And we'll find out later that diversification means a lot of things, or at least a few things. And becoming diversified is important because that is how you ensure that you are getting paid properly for the amount of risk you are taking in the market. There's different kinds of risk. And in our next video, I think that's actually what we're going to be discussing, is the different types of risk inherent in investments and how you reduce that risk. And then how do you ensure getting paid for the risk you are taking? But cutting to the quick, when you invest in the S&P 500, essentially you're getting that beta 1, right? And you are getting this diversification, and that allows you to, have a certain amount of comfort. Basically, you're in on the boat with everybody else. You're not taking any extraordinary risks. Basically, whatever happens in the United States is what's going to happen to your investment. So good or bad. So yes, that can be fine. There's nothing wrong with that. There's some people that's the only investment they have. They take their, imagine being 60 years old, you've got a couple $1 million saved up, or 65 or 67, you have a couple $1 million saved up, and in dividends alone, you're getting $30,000 without touching the principal. Forget the 20% or whatever you made in capital gains last year. Let's say you had $2 million and now you got 2.4. Well, you're expecting to get a lot more money next year, right? You're gonna get 1.4% on your 2.4 million now. So you got a little bit of a raise. You got a nice raise without touching the principal. So, and that's something that's important to a lot of people. When you start digging into selling your stocks, because that's what you have to do. That's what digging into the principal means, basically, is selling some of your shares for whatever reason, for kids getting married, you want to buy a camper, RV, and go across country, or you want to go on a cruise or whatever. So that's kind of an easy way to get some income without doing something. So yeah, it's certainly more appealing for people who need the income. I'm not one of those people. But maybe one day I'll be one of those people. I'll be one of those people who looks for that. So what you want to do if you're interested is you can kind of look at what's going on with the S&P 500, what's going on with the earnings of the S&P 500. Does it make sense? I mean, your price to earnings here, we've talked about this before. Price to earnings is essentially just what it says. It's the price of the of whatever the financial instrument is, in this case Fidelity, but it's going to be the same price to earnings regardless. For any of the S&P 500s, it should be the same, or approximately the same, not exactly the same, but it should be right around this number, this 26.32. So like I say, historically that's a high number, but a high number doesn't necessarily mean it's overpriced. You have to remember there's reasons that a high number could exist and that it makes sense, and doesn't mean that it's overvalued. That could mean it's overvalued, sure. I mean, historically it is. It's higher than normal. But if you believed we were in a slow economic time where earnings were depressed, were lower than they should be, or lower than normal, let's say that's probably better. And now we are going to a period where we're going to see faster gains in earnings, where earnings are going to grow faster. Well, then that makes sense. If you have earnings of, where's the earnings number in here? Well, let's just say the earnings are 10 and next year they're going to be 20. So the price of earnings currently is based on the 10. But next year at this time, after the 20 shows up, well, then the price to earnings are going to, let's say it's 26 right now. Well, it's going to be, if the price didn't change, it's going to be 13 next year, right? Makes sense, of course. So, you've got to keep that in mind when making decisions about things being valued or overvalued. These numbers by themselves, they need context to have meaning. They all need context to have meaning. You can't look at this price to earnings by itself and say, too high, too low, just right. There's no Goldilocks. You have to put it into context. You have to take a guess about the future, or at least an educated guess about the future. 3 years earnings growth, that's pretty strong, right? 19.53, 17.47. That's decent growth. So things to consider, things to remember. And there we go. This is just when it shows the bond ratings, it's basically that little bit of cash it needs to handle that 3% of turnover. So the 3% of shares they have to liquidate every year. That's where you get this little 0.02%. So okay, so there you go. That's a quick look at the S&P 500. See if there's anything else that we want to consider. The S&P 500. I want to get back to the SPY. Let's get back to SPY. I think we're just one behind. The SPY trades like a stock a little bit more, or a lot more. So here we go. That's 24.35%. This was the yield is 1.4%. Why did I want to look at this? I wanted to see if it had a prediction for the future. I don't see one, but that's okay. Looks like we hit some all-time highs yesterday, for closings at least. So, but let's think about the this beta equation real fast, and the S&P 500. So as we saw before, the betas were all approximately 1, and that's an important number. So what is beta used for? So the essential calculation, it's a very simple one. When you're investing, is you want to find the required rate of return for an investment. So what do we use? Well, we use the short-term interest, well, not short, sorry. We use what we call the risk-free rate. Now the risk-free rate has changed over time, not just in percentage, but in what we use as a default. Right now, from my understanding, most professionals use this number as their risk-free rate, right? This 4.094%. If you don't remember what this is the 10-year U.S. government bond as the risk-free rate. Now, does it matter? Yes, it does matter what you use as the risk-free rate, because now you're going to take that and you're going to add something to it. And what are you going to add to it? You're going to add whatever you believe the risk premium is and multiply that by your beta, right? So if you think the risk premium is 3% or 4%, well then, right here we have 1%, right? Our beta of 1. And this is kind of how you kind of back into things. You look at what do we think what's the return going to be of the S&P 500? If someone says the return is going to be 7%, if they believe the 7% is what's going to return, well, it's easy to figure out what the risk premium is, right, for your beta, because it's 1. So it's simply, if it's 7%, then it's 7 minus 4.094%. So approximately 3%, right? That's the risk premium. So now, if you want to go and look at a specific stock, say Apple, right? Now this is obviously as simple as we're going to make it. We're going to multiply this 1.29% by 3. And now we add that to the 4%, right? We add that to the 4% to get what? To get approximately, we'll do some quick math here, 8%, right? Approximately 8%. So you need a required return of 8% to make Apple a reasonable investment, if you believe this beta is approximately correct. Now, always remember, the S&P 500 is a standard 1%. A standard 1 for its beta, no matter what. But other companies, what they do is they run a correlation for these kinds of estimates based on historical information. And of course, the historical, what happened historically is not always going to be what's going to happen in the future. So a company that may have had a historically high beta in the past, it might be lower in the future, but it could also be higher. The sheer size of, and we've talked about this before with Apple, the sheer size of Apple suggests that this beta is a little high. But Apple is one of these companies. It's so big, and people feel they know it. You can do research. It's Apple doesn't have that many products, so it's maybe one of the easier companies out there to actually do a lot of deep research and it actually have meaning. You have a company that has its tentacles everywhere. It's very, very difficult to, get really close to like understanding the entire business. You have a company like GE where they have all of these different aspects to it, and you may have done your homework, but you missed maybe that GE Finance, GEFS was making some bad investments. And it's easy to miss these things when you're talking about such a huge company doing so much. But look, the reality is Apple is a monster company with its tentacles everywhere, but perhaps it's a little bit easier to understand because they kind of stay in, their little walled garden, if you would. But it's, I think it's one of the stocks that people feel kind of comfortable trading in because it seems relatively simple, but I don't think it is. I don't think it's simple at all. You're talking, look at this. They probably hit $3 trillion yesterday. This is a monster company. It's just so big. You look at it, it's just so big that it's hard to, what was the yield? Was it 3% really? No, what's the yield on that? I know the yield was in here. I'm just blind right now. Sorry about that. Here we go. So the yield was 50%. Not 50%, 0.5%. 0.5%, not 5%, 0.5%. So, it's not a high yield stock. But so don't delude yourself. Apple has factories in a lot of places. It's got money in a lot of places. It's, it plays, I'm sure some governments believe a bit of a shell game or where their profits are coming from to reduce their taxes, things like that. Okay. So, but that's basically how you're looking at, I'm sorry, I went off on Apple a little bit there. But that's how you use that number in its simplest form. You use the expected return from the S&P 500. There's a ton of estimates out there on what the expected return is, right? 5%, 7%, 10%, 15%. Now, whatever that expected return is, and it's probably best to get, to work your way backwards. But if you get a 10% expected return, then subtract the current risk-free rate, which in this case is 4, and now you're at 6%. You're at 6% return. And now a stock like Apple, 6% required rate of return for the beta portion of it, right? The risk premium. So you're 6% times 1.29. Now you're talking about requiring 7.5% plus the 4. So now you're 11.5% required for a company like Apple if you believe this beta is correct. Like I said, it may not be in your eyes. You may say, hey, this beta is too high. It doesn't make sense. Historically, it may make sense, but Apple really is not a company that is going to vary that far from, because of its size, because of whatever reason, from the vicissitudes of the United States stock market. So, yes, it's, you have to work through these things logically if they make sense to you, or you could just say, hey, this makes perfect sense. They're coming out with a new product. This product is an important product. Some of its other products aren't doing as well anymore. So it needs this product to do well. If the world is doing well, if the economy in the United States grows, then people are going to be buying a lot more Apple products, and not at just the rate at which the world is doing well, but at a higher rate because the United States is doing well. So maybe that's where this 29% premium comes from. So think about that when you're making individual investments along the way. Now look, if you're invested in the S&P 500, we already saw you're invested in Apple. Every $100 you have in the S&P 500, you basically have $7.5 in Apple. So, you're invested in it, like it or not. And this is how you do get that exposure, that diversification, is by buying something like this that owns a lot of different stocks. Now remember, these index funds don't necessarily own exactly what's there, makes up the S&P 500 in those exact compositions. It'd be extremely expensive if they were trying to do that exactly all the time, right? It'd be impossible, really. So there's a little bit of leeway that they take. So some of them will have a little bit higher return. Some of them will have a little bit lower return. Generally speaking, the returns should be slightly lower than the S&P 500 itself because the S&P 500 doesn't have transaction fees, but index funds do, ETFs do, trusts do. And even if those expenses are low, they exist. So, when you see the S&P 500 is done, it was up, 200% over the last 100 years, the last 70 years, up 1,000%, let's say. Here we go. Let's go for the max. I think this one was open like 92 or something, 93. This is SPY. But, look at that. You're talking over tenfold increase from low 40s to, low 40s to today, 48, 45, let's say 45 to, from $45 in 1993, June 1st, 1993, $45, you could have bought the SPY, and now it's trading at $483. And don't forget there are dividends and things like that have occurred. But so it's had a great run. That doesn't mean the run is going to continue. That doesn't mean the fortunes of the United States are going to continue, right? Because that's what the S&P is based on. And that's what people need to understand when they're investing in stocks. And that's something that's kind of forgotten when you just see the numbers that come across if you don't understand. These things are actually, owners of companies. I mean, they may own substantial pieces of companies. And, these are real things. They're not, it's not just numbers in the sky coming down. They are real things, and how well those companies do affects the return of the indexes. For a lot of people, yes, that's an obvious thing, but for some people, it's not. For some people, they really do not know that, these things matter. They really do matter, how well it's going on. And this one particularly depends on how well these American-based companies are doing. So I hope that you've learned something today. I hope that I haven't bored you too much. I think the S&P 500 is really, established itself as as we can see here, most important index that we have. And because of that, it's important to understand at least how it functions as a part of our investing world. So whether you invest in it or not, it is an important part of the investing world. Thank you, and I hope you come back for some of our future editions.